Welcome back to Alpha Recap. Markets were closed for the day, and we're unpacking the biggest moves and what they mean for portfolios. As always, if you have questions, you can reach us at stockalpha.ai, and later in the show, I'll tell you how to send us a question live. I'm Jeff, and with me is Ben, our commodities and macro strategist. Ben, good to have you.
Thanks, Jeff. Great to be here.
Let's jump in. The headline that jumped out at me was Chevron pushing to a new 52-week high, $181.36. That was the clearest signal of the day. Walk us through why that matters.
A 52-week high is a practical milestone. For traders, it's a momentum cue. People see a new high and it can attract fresh buyers. For income investors, when a dividend-paying energy stock rallies to a new level, the yield on their positions effectively falls unless they rebalance. So you get both technical and portfolio level effects. If Chevron stays above $181.36, more momentum flows could follow and funds might need to rebalance exposure to energy.
So for someone holding Chevron for the dividend, they might be looking at a smaller yield unless they buy more shares, right?
Exactly. Price appreciation lowers the yield, all else equal. Some investors then either accept the lower yield or top up to maintain income. Traders will also be watching if that price becomes support on any pullback.
While energy was strong, tech and AI names had a rougher session. Nvidia finished the day down about 3% to roughly $180.34 on very heavy volume, about 201 million shares. That felt like distribution more than a simple dip. What did you read into that?
Heavy volume on a down day usually suggests profit-taking or distribution from short-term holders. Nvidia has been a focal point for the AI narrative, so when retail attention spikes, you can get outsized trading activity. The fact it fell on that volume is a sign some participants were selling into enthusiasm, locking gains, rather than new buyers stepping in.
Speaking of retail attention, the brief noted a Google Trends spike for the search term AI. About 20,000 searches, a jump of roughly 75%. How does that interplay with price action?
Retail interest is often a leading indicator for trading volume in headline names. When everyday investors start searching for AI more, they tend to funnel trades into a concentrated handful of stocks and ETFs tied to the theme. That can magnify moves up and down because flows become concentrated rather than dispersed across the market.
There was also a corporate move tied to AI. Siemens bought Canopus AI for computational metrology and semiconductor manufacturing. That felt strategically important even if it wasn't a massive deal. Your take?
It matters a lot. It's another signal that AI is moving beyond cloud software into physical capital equipment, the machines that actually build chips. Embedding AI into metrology and inspection can improve yields and throughput in fabs. Over time, that broadens the beneficiaries of an AI cycle, not just purely software firms, but equipment makers, tooling suppliers, and the semiconductor supply chain.
So, while Nvidia was pressured by selling, the Siemens move shows AI adoption is getting broader and more industrial. That's an important nuance for listeners to keep in mind.
Totally. Story and sentiment can diverge over short windows. One stock can be under pressure, while the broader technological change is still unfolding underneath the surface.
Let's talk volatility. Leveraged products really amplified the move. ProShares Ultra Pro QQQ finished the day down about 4.5% to about $52.52 on roughly 128 million shares. And another heavily traded exchange-traded product fell about 2% to $43.30 on about 124 million shares. That felt like concentrated volume.
Leveraged ETFs are designed to amplify daily moves. When the underlying index swings, those products can magnify gains and losses, and if the market reverses, they can suffer outsized mark-to-market losses. Heavy volume in a handful of these products increases execution risk and can widen spreads. For active traders, slippage can be real.
How should a regular investor think about those funds? They can be tempting, but risky.
They're generally tools for short-term tactical exposure, not for buy and hold. If you're using them for an intraday or very short-term directional bet, you need strict risk management. For long-term exposure, plain index funds are usually a safer choice because they don't have the daily compounding effects that can erode returns in choppy markets.
Healthcare popped up as the day's headline risk with Pfizer sliding after data raised questions about side effects tied to its weight loss drug. That sounds like classic idiosyncratic risk. One drug can move a whole franchise.
Exactly. Drug safety signals can trigger regulatory scrutiny, slow patient adoption, and force revenue revisions, sometimes quickly. For a big pharma name, even a single product concern can change expectations for growth. The near-term impacts depend on follow-up data, how regulators react, and how the company communicates. Traders often look for clear follow-up statements or filings before re-entering.
So for investors who held Pfizer through today's move, the sensible next steps are to watch for company commentary and more detailed data.
Yes, look for the company to provide context, look for regulatory filings or updates, and consider whether this alters your longer-term thesis. Short-term traders might find volatility, but long-term holders should reassess the drug's adoption path and revenue implications.
A few smaller corporate items also popped up. Brother got a market award for printers. Dahua showed off AIoT LED solutions at ISE in Barcelona. And Slingshot Biosciences announced rapid expansion into the UK and EU. Small items, but worth noting.
They're worth tracking. Awards and new product roadmaps can lead to distribution wins or incremental sales over time, but investors need to see actual sales and margin impact before these items move earnings models materially. Slingshot expanding into new geographies is strategically relevant for trial access and partnerships, but we don't have financials yet, so it's more of a watch item.
Let's summarize the themes you saw. AI is both narrative and a real industrial story. Energy strength contrasted with growth weakness. Volatility was concentrated in a few instruments, and healthcare remains exposed to idiosyncratic regulatory risk. Anything else to flag?
That covers the big picture. I'd add that concentration risk is important. When a small group of names and ETFs account for most volume and moves, portfolio correlations can spike unexpectedly. Active risk management matters more in those environments.
Okay, practical checklist for investors heading into the next session. What should people watch tomorrow?
Watch Nvidia around about $180.34 to see if that level holds or if selling accelerates. Check flows into leveraged funds. Are they stabilizing or continuing to unwind? Keep an eye on Chevron, whether $181.36 becomes support or draws profit-taking, and follow oil prices. For Pfizer, monitor company comments and any regulatory communication or detailed data. Also watch Siemens for follow-up on integration or customer announcements related to the Canopus AI deal. And keep an eye on Google Trends for sustained AI search interest as a proxy for retail appetite.
Great. Let's close with 3 quick takeaways for listeners.
First, energy strength was the day's clearest cyclical signal. Chevron's new high matters for momentum and income positioning. Second, AI remains the dominant narrative, but retail-driven volume can create short-term volatility even as the theme broadens into industrial capital equipment. Third, concentrated volume in a few names and leveraged products can increase execution risk and portfolio correlation. Active risk management paid off today.
And one practical action. If you own leveraged funds or headline AI names, check whether your exposure is intentional and sized to withstand a swing of the magnitude we saw today. Rebalance or set stops if you need to protect capital.
That's sound advice. Small moves in a handful of names can have outsized impacts on portfolios that aren't diversified.
Ben, thanks for the sharp perspective. Listeners, if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's it for Alpha Recap. We'll be back after the next close. Have a good evening.